Assalamu alaikum, and thank you very much. In the morning we have seen presentations from the macro perspective as well as from the micro perspectives, that how the current system contributed to the crisis. And it all started with a small element, some default in the subprime mortgage market, but which ballooned into a global crisis when one after the other sectors of the financial system collapsed or went into problems. I want to take a very micro approach over here and discuss the declining partnership or diminishing partnership as a cure to mortgage-based crisis and providing a helping hand to homeowners. This last part I have taken from a recent article that came up in Economist. What are the costs of a financial crisis like this financial meltdown? It is not only the fiscal cost, the financial stimulus that the governments give in to bail out the banks. It is not only the financial losses that the people, individuals and the institutions will suffer, but it is actually the deadweight loss that the economy will eventually get in the form of diverted policies, in the form of closed businesses, etc., etc. And these are the real costs of the crisis, which are too great. One aspect of the interest-based finance is that it induces bankruptcies earlier than optimal time and in larger numbers and larger amounts due to rigidity of this contractual payment obligation. This has been said previously by many Islamic economists, but this has become more evident in the present crisis, which had its sources in the subprime mortgage of housing. The subprime category of houses had accepted debt contracts with trigger clauses. The trigger clause was that it will accelerate payment obligations if the market interest rates goes up. The interest rates indeed went up and house prices started to go down. This created difficulties. And this was shown in the presentation of Dr. Sami, that how house prices went down. I have a graph also, we will see in time. This created a difficult situation for the households, not only that they had to manage higher immediate payments from the smaller disposable incomes that they had, but the declining prices of homes eventually made their investments worthless. That they would have ended up paying a higher mortgage cost than the value their house would fetch for them ultimately in the market. While stopping the mortgage payments and thus defaulting on their loan would have only triggered repossession of the house, which was given as collateral by the financing firm, and arrested their losses. So there were plenty of incentives for these borrowers to default, to walk away from the house. And there was another behavioral aspect that yesterday Mr. Muhammad Amin talked about, that in this category of household there was tendency to keep the car rather than to keep the house, and walk away from the house but keep your car and other belongings. So moreover, when the mortgage lenders try to sell, when they repossess these houses and when they try to sell it in the market to recover their loans, they not only suffer from the losses that nobody is taking care of those houses because no houses require keeping up, but they also suffered losses because of flooding of house supply in the market and the prices went down. What the prudent lenders would have done, the prudent lenders would have come to renegotiate with the borrowers so that they can reduce their interest obligation, or they could have given them more time. But thanks to this securitization, that now the people who are holding the credit were not the real people who had originally given out the loans. So there was a dealing between the lenders and the borrowers, and there was no question of renegotiation. So it became as if it was a no recourse loan, that we could not come back and renegotiate with the borrowers. And as a result, the underlying collateral, which was house itself, its prices were falling, and we saw that what happened. This is a graph taken from that same Economist article that I'm talking about, which shows that house prices went up and then started to fall down from 2006. And the second graph, which is going up, it shows the number of foreclosures in US in the thousands. That you can see the foreclosures or defaults started to increase a lot. In this context, when many households are losing their houses, and there is a talk now to provide a helping hand for the homeowners. And recently, Professor Zingales from Chicago, University of Chicago, has come up with a proposal which is called Plan B. If you search internet, Zingales Plan B, you will find this proposal. What he says is that whenever a 20% fall in the house prices occur in a neighborhood from the time when the borrower bought his house, it would automatically trigger an option to alter the terms of the loan. The lenders that would be forced to reduce the mortgage obligation of the borrowers in proportion to decline in the home prices in order to preserve borrowers' incentives to retain the houses rather than walk away from it. What is this? Can we think of anything in the Islamic finance?
Can you say it again? Can you say it again?
Okay. His proposal, Professor Zingler's proposal, is that if house prices in a community went down drastically, his drastic reduction is 20%. Within a small span of time, or from the time when the borrower has borrowed the money, if the house prices went down by 20%, then
20 minutes?
Yeah.
So, 7 minutes past now.
Okay, that's good.
15 minutes.
Fine.
Let's go back to 30.
Yes, I will go to plan C now, because that's my plan. So whenever the house prices went down by 20% in a community, that he's saying that lenders should be forced by the government to reduce the obligation in proportion to the value of the reduction. What it is close to in Islamic finance? Isn't it close to diminishing partnership?
Yeah, risk sharing.
That if your house values, your returns or your payments are tied to your house value. So this is my
The rent will go down, but the amount
okay.
ownership
Okay.
parts will go down.
I'm not giving the entire plan of Professor Zingales. What is the incentives for the lenders? Why they are going to accept it? Make them share in the capital gains, in future capital gains of the houses. This is incentives. So this becomes, don't allow them to repossess, keep the house with the borrower, just reduce the obligation of the borrower by the amount of the proportion of the decrease in price, and give an incentive for the lender to have a share in the equity of the house in future when the house prices will eventually rise up. And this involves a renegotiation phase that you have to renegotiate, which is costly. Now, this was Plan B proposed by Professor Zingales. He defines a trigger point, and whenever that trigger is achieved, like 20% decline in price, the force lenders to alter the terms of loan, reduce the mortgage obligations.